Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Traders cement bets of a Fed cut next week after inflation rises no more than forecast. The euro area central bank is expected to deliver its fourth rate cut this year, with Swiss policymakers also meeting today. We are live in Frankfurt ahead of the ECB's decision. Plus, China shares rise on optimism of more stimulus from a key economic policy meeting.
In the meantime, quick check on these markets. The green on the screen from China not translating to the futures picture here in Europe. Eurostoxx 50 futures and FTSE 100 futures virtually flat. Marginal outperformance here in the UK, but strength when it comes to the currencies. 105 on euro dollar ahead of the ECB meeting, and a reference and cable at a 127 handle. The countdown to the opening trade starts right now.
Thursday morning, good morning. Central banks take central stage. The Fed cut 25 basis points yesterday. That's what it felt like. We saw the CPI number. The market priced in almost 100%. It seems like a done deal. So the Fed's done. The Fed's cut by 25 basis points. Now we move on to the ECB. It's expected to cut by 25 basis points a little bit later on today. Got the SNB. The Canadians just cut by 50 basis points. Central banks firmly in focus. But yesterday, the Fed cut by 25 basis points.
That's very nice, like what you've done there. But, I mean, they didn't, but it feels like they did, is your point, just in case we really confused anybody and they thought they'd woken up next week. But we did get that inflation data that meant that the market increase its bets that the Fed is going to cut next week. So that's the direction that we do seem to be moving in. We heard from Loretta Mester, and she making the point that a lot of people have made about the stalling progress of bringing inflation down. And that does seem to be where the market goes next. So even if we get that cut next week, just how hawkish is that cut? How hawkish is it about 2025? How much does the Fed decide to address or not address some of the tariff issues and what Trump will mean for policy and inflation there? And, of course, we're not done with the data because we get PPI today, which gives us clues on PCE.
Yeah, all these fun data points, which brings me back to I feel like the original one, the sensitivity to the jobs market, which is what Powell has continuously referred to as a sign of the economic resilience. And Bloomberg Economics coming out and saying that 227,000, for example, jobs jump that we got last week should not hinder at all the plans for a cut. I'm wondering what that threshold is, though, when it comes to potentially going to pause. What will the Fed point to and say, actually, this is enough?
I think we're about to find out. I think they've got a lot on their agenda. They need to be thinking about how to price in the Trump story. I think the data yesterday was really interesting. I've read a lot of people writing about the fact that actually what it signalled was that inflation was under control. You strip out housing, and actually the numbers look broadly in line with where you'd want them to be. And therefore, actually, the Fed's kind of job done, delivered what it needs to deliver. Others are saying this is still sticky inflation. Look at what is happening in housing and also what's happening in services. Back to the labour market, the fact that that's going to be tight, what happens with immigration, all kinds of other factors. So the market's quite divided on this.
Deutsche Bank, I think, were out with a note on exactly that latter point. It does seem like there was something for everybody in that CPI
which seems to be true of every data point
Every data point in 2024, perhaps. But certainly when you get it in line, it reinforces the views that people already have.
Feels like a very different kind of picture over at the ECB, doesn't it? It's going to be dealing with an economy that is declining. We're going to get fresh staff projections today. The expectation is that they're going to paint a fairly dismal outlook for the European economy going into next year. Fourth cut coming through. It's likely to be a dovish message coming through from Christine Lagarde. It's likely to be a fairly unanimous governing council as well.
Yeah, I mean, and what commentary do we get around the neutral rate? Because that does seem to be, Tom was picking up on this at the end of the last hour, there's so many different definitions of the neutral rate, and of course we're not going to get an answer on that from the ECB, but each governing council member having such different assessments of what neutral looks like certainly seems like something that will have a big impact as to how many cuts we get from the ECB in 25.
And who are they catering to? I know they kind of speak to the whole Eurozone as a whole, but I feel like they really need to be paying attention to what's going on in France. And yet the commentary has been, this is still a domestic issue. We're not seeing any sort of shock to the system yet. And you've heard that time and time again, that this is not the point that the ECB needs to actually be worried about. I wonder if we get a different message from Christine Lagarde today, in addition to the weakness we're seeing in Germany and an election story there.
You could argue if it was just the German and French central bank, you'd be cutting by 50 basis points.
Yeah.
You'd probably be much more aggressive at this point.
Yeah.
But they are setting policy for the wider story. And I think there probably also is some caution in the messaging as well. We don't know what's going to happen next. We're entering a period of huge uncertainty. Do you want to deliver a 50 in that kind of environment?
Do you keep your powder dry? Also, do you want to look as if you're panicking, you know, when you're not maybe panicking, you're just concerned about some downside?
But isn't that the argument, though? And this is coming out of the Jay Powell playbook of 2019, insurance cuts to kind of almost bake in or get ahead of a lag that may exist when the news actually hits. At least that feels like the message coming out of China as well, where you have talked about the story. They're taking a more dovish stance on their monetary policy, where a lot of the experts have come on this show and said, actually, that is a response to an expectation that a second Trump administration will be tougher. So they're getting ahead of that in terms of creating that kind of stimulus. And they're not done with it. It's not just the monetary policy story. I believe local media reporting that consumer vouchers were part of that stimulus story as well. To what extent is that helpful? I don't know, but certainly something that moved the market today.
How longer lasting is that? Yeah, is that just a short-term sugar rush, if that's what we get fiscally?
How long does it need to last? It still feels like China has yet to deliver the epic stimulus that everywhere else had post-pandemic. That's kind of what we're still waiting for, and it hasn't been delivered upon. When does that come? And are those two things comparable? The inauguration is going to be interesting, though, isn't it?
It is, and an invitation extended to Xi Jinping, CBS reporting that from Donald Trump. We'll see if he actually decides to come. Not everyone does when they get invited to the inauguration, but it is certainly a olive branch, it feels like, from and a very differing approach from his first administration.
Right. I mean, it's a reminder of his operating style, isn't it? That even when you're going, you know, combatively against somebody, you can still welcome them into these set-piece events. It seems to be something that struck a chord.
It just reinforces the transactional nature that everybody seems to be focusing on at the moment. There's this consensus that exists at the moment within the market that this is going to be hugely transactional and therefore is going to be largely benign and therefore actually is going to be something that the markets can manage. Is that in reality going to end up being the case? I don't know, but that's certainly... Everybody I'm talking to at the moment seems to have the same narrative. Oh, it's going to be transactional. It's OK. Don't worry about it.
So
it's
anything that looks like it's not that at the start of 2025 is going to be a shock to the system, isn't it? Shock to market expectations.
The problem, though, is that deals were brokered in that first administration. The farm deal, for example, that was then not coming through, right? There were these quotas that China had to buy certain agricultural products, and then they never filled those quotas, and that was a real Achilles heel to some of that Trump policy.
Got to get done. Nicola Mai's going to be joining us, portfolio manager and sovereign credit analyst at PIMCO. Lots to discuss with him as we work through these central bank stories. Sonia Lord, CIO of Legal & General, joining us a little bit later on the show. We're going to talk capital markets as well. Kriti's favourite subject, Silvia Vivano, head of equity capital markets at UniCredit, joining us in the latter part of the show. Looking forward to that.
Love a capital market story. Love a little liquidity, a little market plumbing. I'm all about it. But it does feel like today the big story is going to be, of course, the ECB rate decision. That coming up at 1:15 p.m. UK time, plus a little bit of other U.S. data as well. We talked about the CPI report. We're going to get PPI today, just 15 minutes after the ECB rate decision. I wonder if that creates a little bit of whiplash maybe in the bond market for that moment. Jobless claims coming in at the same time as well. Then at 6 p.m. UK time, an auction on the long end of the U.S. curve, a 30-year bond auction. We'll keep an eye on that in terms of the demand on the heels of that data as well. And then some earnings. Costco, Broadcom as well. And on top of that, we've got the SNB later in our show. Yeah, we do. We have the SNB deciding on their interest rate strategy in the show. We are expecting there another 25 basis points cut from them. That would also be the fourth time that they've done it, as it would be for the ECB. But there is the outside chance that we get 50 basis points from the SNB today. But they do have limited room to cut because they've done so already. And so that's one of the arguments as to why they stay gradual.
The starting point was quite low. But they're having zero... What effect is the SNB having? If you take a look at it through the lens of the currency, the chaos that is being caused at the moment in Europe, France, let's use that as the example, is causing the Swiss franc to appreciate. The SNB keep cutting, but actually it's having very little effect. And you do wonder, therefore, what else they're going to have to potentially do. They can get to zero. Do they need to go negative? Apparently that's still in the toolbox. But what effect will it actually have? They've cut. Every time they cut, it seems the currency goes up rather than down.
Yeah, and I was reading, and looking at a basket of currencies, it seems that there's been little change over the last week or so with the amount of political turmoil, to your point, Guy, that we've seen in Europe. That seems kind of incredible. But, you know, on the one hand, you've got the downward pressure from these rate cuts that have been coming. But on the other hand, we do have that geopolitical risk. And on top of the monetary policy, one of the big conversations in Switzerland as well is what changes do they make around the capital risk rules for UBS, and that's going to be something that the SNB did kind of briefly have a hand in when it came to that Credit Suisse merger. Bastian Benrath, who covers both the SNB and UBS, will be joining us from Zurich later in the show.
Yep, we'll get the latest from Bern. Let's talk about what else you need to know this morning. The New York Police Department is investigating a number of wanted posters of senior corporate executives that have been hung in parts of the city. The posters include images of United Healthcare's Brian Thompson, who was murdered last week, as well as finance leaders from American Express, Goldman Sachs and Bank of America. It's the latest development amongst a string of incidents causing anxiety amongst business leaders in the wake of Thompson's fatal shooting. South Korea's President Yoon is vowing to fight to defend himself against impeachment efforts. In a speech earlier today, the embattled president said the purpose of imposing martial law last week was to save the country and protect, quote, free democracy. Yoon's own party leader has called for his impeachment. A second vote is expected on Saturday. And Bloomberg has learnt that French President Emmanuel Macron and Poland's Prime Minister Tusk are set to discuss the possibility of sending European troops for a peacekeeping mission to Ukraine once a ceasefire is reached. The talks follow meetings Macron held with the US President-elect Donald Trump and Ukraine's leader Zelensky in Paris on Saturday. This as diplomatic efforts to end the war gain momentum. Talking of Macron, still don't have a French Prime Minister.
No, just keeping the audience
meant to be tonight. Meant to be tonight.
Tuning in this morning and wondering, do we have a French Prime Minister? The answer is no. We do have efforts, of course, by the caretaker administration to push through the finance bill. But now they're all arguing about what it is possible to change in this emergency legislation, this loi spéciale. What can you actually change in that? Not as much as some would like, according to the answers we're getting out of Paris at the moment.
But it might be almost a positive result in that even if you do have the austerity baked into the rollover, that actually could help the deficit issues that they're struggling with as well. To me, it's interesting on the political front, even as he's battling kind of the internal domestic politics internationally, he's kind of at the center of some of these potential ceasefire negotiations in Ukraine. First with Donald Trump and Vladimir Zelensky at the Notre Dame Cathedral, yep. And now going to Warsaw this morning, all while still dealing with the domestic situation that Anna just laid out.
The FT is leading with a story this morning talking about the fact that NATO and Rutte are talking about a push higher in terms of the minimum for NATO spending to 3%.
We had some of that coverage yesterday as well, and we got into that conversation with Tim Ash, didn't we? And he was saying 3%. He was talking about going back to levels during the Cold War, in fact, in terms of the amount of defence spending that's going to be required.
And that was something that Donald Tusk out of Poland has been pushing for very far, because Poland has, I think, 4%, and they've been trying to get everyone else to get on board.
Can Europe afford this, though? I think at the moment the answer appears to be no.
Yeah.
So how does that happen, and what has to give? Like welfare spending, what happens with the green story, what happens with all of this?
Yes.
If the pot is, if you think about it as a zero-sum game, where does the money come from?
And how much of that burden is shared across Europe as well, as part of the conversation. Coming up on the programme, then, we will have plenty of the macro for you. US Treasury Secretary Janet Yellen says a softer global oil market might create an opportunity for further action against Russia's energy exports. We'll bring you some of that exclusive conversation later in the show. Plus, as we've been discussing, NATO is said to be weighing plans to assign new targets for boosting the number of air defences and weapon systems among its members. We will have all of those details. And later, we will hear from Christophe Debu, the CFO of the travel tech company Flix, about why the company postponed plans for an IPO. We'll tie some of that into our reporting around European equity capital markets. That's ahead, the European premiere of Bloomberg's latest episode of Chief Future Officer. If you have questions, if you want to get involved in any of these conversations this morning, IB plus BBTV Go. That is the function this morning to get in touch with the team. This is Bloomberg.
Barring some shock, the CPI numbers will trend down next year, and the next few months are going to show some high year-over-year numbers.
Yes, the rent component's coming down, but as you mentioned, there's other elements that have been negative that are now going positive again. So it's really a give and take.
Notwithstanding the CPI print this morning, I think we're still pricing a greater likelihood of a 25 basis point cut into the end of this year.
So I do expect that the dot plot next week will be a little bit more cautious than the one in September.
As we head into 2025, there are some uncertainties. We'll have to see what types of policies present themselves. We'll have to see how the economic growth continues to unfold. There currently are more cuts priced into 2025.
A few views on the Fed post the CPI number yesterday. My view is that it seems that the Fed cut rates yesterday. 25 basis points was delivered. The market certainly responded to that. I'm joking, of course. We get that next week. The market certainly responded to it, but the Nasdaq pushing higher and higher and higher. Valerie's got all the details.
Exactly right, Guy. Lack of surprises in that inflation print yesterday allowed this equity rally to resume. We saw the Nasdaq closing at a new, fresh, all-time high yesterday, getting very close to being up 30% on the year. Now, attention now shifts to, instead of that 25 basis point cut, we know that's baked in. The attention now shifts to what we could see on the Fed's dot plot. Remember, back in September, they penciled in 4 cuts for 2025. The market is pricing in 2. Just what could we get revealed in their dot plot next week. Now, the next risk event on the horizon is the ECB, and the ECB is battling a lot of things on their plate. They're likely to go for a 25 basis point cut today, but they are also going to be releasing their economic projections alongside this rate decision. Remember, they're battling a manufacturing downturn that's spreading into services. We saw that in the last PMI data. Also, this overhang tariff threat from President-elect Donald Trump and the recent government collapse, not only in Germany, but in France. But back to those economic projections, Guy, because I found this very interesting. Of the economists surveyed by Bloomberg, a whopping 76% of them see that the growth is going to be revised down for 2025. The ECB had penciled in a 1.3% GDP growth for next year. My eye is immediately going to go to that when these lines cross the tape. Just how much lower do they see a growth for next year? I think the reaction in the market, especially when it comes to the currency, when it comes to the euro-dollar, will be based on that projection.
Valerie, thank you very much indeed for walking us through the Fed and what is happening with the ECB. Nicola May, portfolio manager and sovereign credit analyst at PIMCO, joining us around the table. How dovish is Lagarde going to sound today?
I think she's going to sound pretty balanced because there's still a governing council that has mixed views about interest rates. I think at the margin, the move will be in a dovish direction. So I think they will remove the sufficiently restrictive need on monetary policy. Again, I wouldn't read too much into it because some people in the council believe that we're already at neutral. But I think they will basically, guide towards a still meeting-by-meeting approach, but one that gives a sense that more rate cuts are coming.
More rates? How many?
We think that the market currently is pricing more or less the right amount of rate cuts. If anything, I would bet on more rate cuts than what's priced in. The terminal rate priced in the market is 175. I think there's a lot of downside risk to the European economy, so I'd be happy to generally take the under on that one.
Nicola, I'm wondering just how many creative ways journalists will find today to ask her about France, Germany, political instability, and how many creative ways she will find to avoid answering questions on it, I imagine. But thinking about where the political instability takes us, I mean, how much do you think the ECB should be thinking about that? Or do they just put it to one side and say these are domestic issues, there's no systemic risk, no reason for TPI or any of that kind of thing, therefore just leave them to it?
I would think right now there is no reason for the ECB to intervene with the TPI or any stabilization programs. I mean, France has widened, but there's nothing systemic in it, nothing too volatile. I think they will take this into account in their macro projections in a way. And if anything, I would say the politics create some downside risk on growth. I mean, arguably, France will do a little bit less fiscal easing, which is positive growth, but against that, financial conditions are tightening, business confidence will probably be eroded. So at the margin, I think that adds to the weak macro momentum.
Yeah, MEDEF, the business lobby, has certainly been making the point about uncertainty for business and what that's doing to investment. What's the significance, do you think, for the ECB of this blurring of the line between the core and the periphery, the redefinition of what core and periphery means in Europe? Because it's so different now to what it was, 10 years ago, for example.
I think that's right. I think that line is getting blurred. I think you're seeing more macro convergence, so the core countries are getting weaker relative to the periphery, and paradoxically, that could actually lead to more stability, because when France and Germany are weak, then potentially the appetite for more cross-border support, coordination actually rises. So if anything, I would think that sovereign spreads as a whole can actually probably cluster around a fairly contained level, potentially lower than you had a decade ago because of this additional cross-regional cooperation. And what that means for the ECB is that at the margin, potentially if sovereign spreads are somewhat tighter, they can actually allow the policy rate to be a little bit higher because that offsets, obviously the tighter spreads offset some of the policy rate increases.
What is that red line, though, for the ECB? I hear you in that there's no need to intervene at the moment. But when I was in Paris covering this stuff, this was the consensus on the ground was that eventually the yield premium would hit 100 basis points or potentially higher, but it would do so gradually that it wouldn't be a systemic risk. What is that a red flag for you?
So it's hard to know exactly when the ECB would intervene. It also depends a lot on what the reason for the widening of the spread is. I mean, if you have a government which all of a sudden is, outright Eurosceptic and, does not want to comply with the European rules, that will make it much harder for the ECB to intervene. If it's a market-driven stress or fear type event, then the ECB would be inclined to intervene. But I think we're so far from that kind of scenario right now that I don't think it's particularly relevant.
Are you being compensated enough to own French debt right now? Is that premium big enough?
We think France is pretty fair here. I don't have a strong view. You're at around 80. You're wider than Spain. I think it's justified. I think you're going to have fiscal slippage, political volatility. So, we're not jumping into France at this level. We think that there's more volatility ahead. But nor do you really want to be short because you've already got, a decent amount of widening behind you.
So I'm going to watch the look on your face when I ask this question. Is the Fed done next week? Is that it?
No.
Okay.
My view is the Fed is not done.
Yeah.
If you look at Taylor rules, you're still above neutral. And, ultimately you are seeing progress in disinflation, even though yesterday's numbers were a bit, show a somewhat slower progress. But I think there's more.
I look at your face because a lot of people I'm asking this question to at the moment are kind of pulling a face when I ask that question because it's becoming harder to read, I would argue.
It is becoming harder to read. I think the Fed will cut next week and it will do a hawkish cut where it raises the policy rate projections. But, I think the level of the policy rate relative to most estimates of neutral remains restrictive. And I think, as we go into the next year, there are reasons why the U.S. economy will slow. And I think the Fed will continue to. So
we get more cuts. That's on the monetary policy side. On the fiscal side, we had an interview with Janet Yellen yesterday, and she was saying, if you keep the Trump tax cuts, which of course we know is part of President Trump's plan, President-elect now, Trump's plan. She said that would be a severe fiscal blow. How concerned are you going into another Trump presidency about the fiscal stability in the U.S.?
Yeah, look, I think the deficit will remain wide in the U.S. I think that was our expectation, and I think it's pretty much confirmed by the recent rhetoric. So how much of it is a concern? Well, we're trading that in the sense that, the wider fiscal deficit, the bloated balance sheets of public sectors make us cautious in the long end of the curve. So we like the curve steepeners. We think that, neutral rates are low, and so the front-end rates are anchored. But investors need compensation for the higher debt levels, and that's why we're cautious the long end of the curve.
Very quickly, let's talk about that long end of the curve. 449 on that 30-year. How high, how low can it go? Give us a range.
Hard to give a range. I would say that the risks are, for higher rates, certainly relative to the front-end rates.
All right. Nicola Mai. We'll leave the conversation there. Portfolio manager and sovereign credit analyst over at PIMCO joining us this morning. Guys, it's really interesting that he's talking about this, that the concerns in France may not be systemic risk, but he's more concerned, it feels like, about the fiscal deficit story in the U.S. That's what I heard.
We just don't know yet. This is the problem. We just have no idea. Is the U.S. government about to become significantly more efficient and therefore potentially will spend less? If you listen to Elon Musk, maybe the answer is yes. But the expectation is we're going to see, pretty smiling, significant tax cuts.
I love it.
Significant tax cuts coming through. There's going to be stress at the longer end, which is why this curve steepening story is there as well. I'm drawn as well to a headline that's just crossing now. China willing to increase talks with the US on trade.
And that's moving the yuan a little bit this morning, isn't it? I mean, and this coming as we're waiting for conclusions out of the Central Works Council, following on from the Politburo at the start of this week, Kriti.
Yeah, and that having ripple effects into the dollar, a little bit of a spike in the euro as well, and the Swissy, I should add. Coming up on the program, we do look ahead to the SNB rate decision this morning, how the Swiss Central Bank weighs the country's rising currency. All of that and more. We will be live out of Switzerland shortly. Stick with us. This is Bloomberg.
Welcome back, everybody. This is the opening trade. 30 minutes until we get trade here in equities in Europe. Let's have a look at the futures picture. Yesterday in the United States, we edged a little bit higher, then came off those highs after the European close, so some suggestion that could put a little bit of upward pressure on stocks this morning, but really isn't much, is it? And in fact, it's faded just as I've been talking, so we're pretty flat on Euro Stoxx 50 futures. US futures flat to negative, so down around an 1/8% or so on E-minis and NASDAQ futures. We are waiting for the data out of the United States to continue coming in. PPI today, that'll give us more inflation clues around the PCE number in the United States. And, of course, we're waiting for the ECB rate decision. Let's have a quick look at bond markets then with all of that in mind, waiting for the ECB decision. As we wait, we are at 2.915. That is the yield on the French 10-year. Thought I'd check that one this morning because we are, of course, waiting for a Prime Minister to be appointed in France. And so that's going to be something that, even if it isn't mentioned by the ECB, will certainly be there in the room. Let us go now to that ECB conversation. The European Central Bank is holding its final policy meeting of the year today and is widely expected to deliver its fourth rate cut of 2024. Traders will also be looking for clues on the path ahead. Of course, our correspondent Lizzie Burden is in Frankfurt for us. Lizzie, good morning to you. So is it a jumbo cut off the table then? Is that what we've heard, the sort of mood music coming through from various policymakers at the ECB?
Well, Anna, speaking of music, unfortunately, you've just missed the carols here. We're feeling very festive in Frankfurt. But in terms of the mood music for the decision, at least from Martin Kazaks, the Latvian central bank governor, we've heard that they are considering a 50 basis point move, but it isn't what we're actually expecting. They're back. The music's back on. Look, the reasons that they are thinking about growth in particular are all these risks that you flag since the last meeting when we were in Slovenia. At home, you've got the collapsed governments in France and Germany. There's doubt over how much fiscal tightening the ECB can rely on to bring down inflation. And then abroad, of course, Donald Trump's been re-elected to the White House. The euro area very much in the firing line when it comes to his tariffs. So that would put the argument to preempt those growth risks with a jumbo move today. But it's only JP Morgan in our survey who sees that actually happening. Because, look, it's 7 weeks until the next meeting, only 7 weeks. By then, Donald Trump will be in position. We'll have hopefully more clarity, hopefully, on what he's going to do. And also, you haven't got even the doves speaking loudly about a jumbo move today. And the hawks for sure aren't likely to go for a jumbo move, given that rise in negotiated wages in the third quarter. So it's on the table, perhaps, but seems highly unlikely.
So, Lizzie, what kind of signaling could we actually get from this decision?
Well, it's going to be interesting, Kriti, because the forecasts will come out today, out to 2027. But given those risks are set out, they'll be clouded in uncertainty. It's not really clear how much clarity they'll actually give us. And that's why I think they'll lean on scenarios rather than a base case. We have, since the last meeting, seen a darkening of the inflation and growth pictures. You remember those PMIs in November. And at the last meeting, Christine Lagarde did say that the inflation risks were tilted to the downside. Maybe we see that actually coming through in the statement this time. I doubt she's going to want to wade into the politics at the press conference. But when we hear from her, I do expect, again, we'll get this meeting-by-meeting approach, an emphasis on data dependency, but perhaps this time a bit more of a dovish tilt.
I think doves are quite Christmassy. Two turtle doves, isn't that kind of what we talk about at Christmas? Anyway, I just try and tie the line between what is happening with the music.
2 layers of thermals in a chilly Frankfurt, Guy.
You're inside now, you're fine, don't worry about it. Let's talk a bit about where we go. Where's neutral? How far do they need to go? What is accommodative? What does that look like?
Yeah, that is massively the debate here. And when we've surveyed economists, they see 2% as where rates end up. Traders, however, see 1.75%. And a lot of this debate about where neutral is, and I should say it's happening much more openly at the ECB and the Fed than at the Bank of England, comes back to the issue of how much monetary policy can actually do to solve the euro area's economic problems, as so bluntly highlighted by Mario Draghi. You know, you've got poor productivity, you've got the lack of financial integration, you've got poor demographics, really, when it comes to the workforce and a shortage of skilled workers. But really, how much can interest rates do to solve that? We spoke, of course, to Isabel Schnabel, and hawks like her would put the argument that it means you should stop cutting rates sooner, which comes back to this broader debate of where the neutral rate is and whether to go below it.
Lizzie Burden, made of sterner stuff. Let me just point out, Lizzie knows how to dress for the outdoors and the cold, though she's nice and toasty inside with all that lovely music. Lizzie Burden in Frankfurt, thank you very much indeed. We're going to have full coverage of the ECB rate decision coming up due, of course, 1:15 London time, 2:15 over in Frankfurt. We've got the ECB press conference, led, of course, by Christine Lagarde. That happens at 1:45. We'll have live coverage of that as well. That's not the only central bank we're watching. A little earlier than that, we're going to get the SNB rate decision, 8:30 a.m. Where are we now? 7:30, so we're about an hour away from that decision. Edging towards, obviously, the end of a two-year stint of positive rates. Is that something that we should be watching out for? Bastian Benrath, joining us now for more from Bern. Bastian, the question at the ECB is, should it do 50? The answer is apparently not. What about the SNB? Could we see 50 there?
Well, it's certainly an option which is on the table. The thing with the SNB is that their rate is already one of the lowest in the world. We just saw it in the chart. It's at 1%. So if they did a 50 basis point cut today, they would give up half of the easing space which they have left, which is severely limited. And they will probably need some more easing space, like more cuts are expected down the road, because the franc is just so strong, and that pushes down Swiss inflation. Swiss inflation is only at 0.7%. So we have a much lower price growth, much slower rise of prices here in Switzerland than in the surrounding euro area. And they will just want to, the policymakers here in Bern will just want to stop that from going below 0%, because obviously you don't want prices to fall. So I think the SNB will need to carefully weigh whether they want to do something like move forcefully against the franc, and need to balance that with preserving some easing space, which they may well need down the road.
OK, so they'll weigh up all of that when deciding whether they go 25 or 50. We know we've been wrong-footed and surprised, thrown curveballs by the SNB in the past, so we stay ready for anything in just under an hour's time. How relevant is it that we're kind of under new management here at the SNB? We have a new face at the table, or a new head at the table, Schlegel leading his first meeting at the SNB.
Yeah, that is true. But we can't forget that Martin Schlegel was a longtime protege of long-term President Thomas Jordan, who has left the central bank at the end of September. So I don't think that we should expect massively different policy from him. I think the SNB is always trying to be very data dependent, even though they don't really talk about that or don't put that into the spotlight as much as Christine Lagarde does over in Frankfurt. So I think we will see a very measured decision. I think we're not going to see massively different policies. However, it's a new lead, and sure, it is a possibility that Martin Schlegel will want to leave a mark.
Well, Bastian, in addition, of course, to the SNB decision today, you have also been monitoring a potential probe into what went wrong with the Credit Suisse story, one that could affect the capital kind of stake that UBS has. Can you walk us through that story, how big of a deal it is for one of the biggest banks in the world?
Yeah, it's kind of definitely a big deal, because the Swiss political system is just very deliberative, meaning Swiss people vote up to 4 times a year on various issues. We have a very direct sort of democracy here. This probe, which you're referring to, it's a parliamentary investigation commission, which has been tasked with looking at what went wrong at Credit Suisse and what went wrong with the government response to it in particular. And that may well set the tone for what regulation we will see at UBS. We can't forget that the UBS balance sheet is twice the size of the Swiss economy. So there is definitely a good cause for strict regulation. And the outcome of the probe, which is expected between now and Christmas, so sometime over the next 10 days likely, will just set the tone. It won't have very direct policy implications, but we will be able to see kind of where we're going, especially on the question of the capital requirements for UBS.
All right. Bloomberg's Bastian Benrath, right, joining us this morning out of Bern, Switzerland, walking us through not only the SNB story, but, of course, what's going on in the Swiss banking story as well. We thank you so much. Coming up on the program, Donald Trump extending an olive branch, reportedly inviting the Chinese president counterpart to his inauguration in Washington. But will she accept? We discuss next. Stick with us. This is Bloomberg.
Broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them and harm our competitiveness.
U.S. Treasury Secretary Janet Yellen, they're speaking to Bloomberg exclusively. Now, despite the threat of stiffer tariffs on China, U.S. President-elect Donald Trump has reportedly invited Xi Jinping to his inauguration in Washington next year. Let's bring in Bloomberg's Jill Deasy's joining us this morning out of Hong Kong. Jill, walk us through the logic here. Why the invitation, and how likely is it that Xi Jinping will accept?
Hey, Kriti, yeah, this is a really, really interesting one here. I mean, the fact that, Trump has extended this invitation to Xi is really quite unprecedented when you go back through, just sort of all kinds of history here. Not really a whole lot of precedent for a foreign leader attending a U.S. presidential inauguration like this. So that's already, really quite unusual there. Now, in terms of whether Xi is actually going to attend, so far, China's foreign ministry hasn't really said anything about this, but really, there's not a whole lot in this for Xi. I mean, the idea of him coming to the United States, sitting through a Trump speech like that, I mean, at this point, Trump certainly has a habit of going sort of, off script, everything like that. There's a bit of a still antagonistic relationship there between the U.S. and China, particularly, when it comes to Trump. So not sure that Xi would actually want to sit through something like that. And then obviously Trump made, increasing tariffs on China by as much as 60% in some cases, really a cornerstone of his presidential campaign. That all being said, what we've seen so far with some of his, appointees, is there's a bit of a mix between people that are really hawkish on China and some that are a little bit more moderate. So it's really interesting to see what this is actually going to say about China, about Trump's policies on China going forward.
Meanwhile, Jill, we're waiting for further information to come out of the Central Works Council. Waiting for, well, we're not, are we sure what we're waiting for? How much detail we're going to get on either growth targets for the year ahead or, crucially, how much fiscal stimulus and what shape that fiscal stimulus might take?
Well, and I'd say probably some more details on stimulus more than those actual growth targets. Now, while China does usually discuss, targets for next year during these types of meetings, we really don't actually see those start to get publicized until much later, around March, when they've got their big annual legislative meeting. Although I will say last year, the premier kind of front ran a lot of that at Davos in January. So we'll see how that comes together. But ultimately, what you might get out of the Central Economic Work Conference report is maybe some more details on what exactly they could do on the stimulus side of things, whether fiscal or monetary. We already got a preview of this when the Politburo released its latest report just earlier this week, and they actually changed some of the language around monetary policy to talk about, how they get a bit looser, which was a pretty big development there. I mean, China hasn't really changed tack on policy in that way in, something like, over a decade. So there might be some more hints toward more of that coming out of the Central Economic Work Conference. In terms of how detailed that's going to be versus just very forceful language, we'll actually have to we'll have to wait and see whether we actually get more details there.
Waiting for details. We're waiting for details on everything, Jill. How much noise is there versus signal at the moment? How clear is the signal as to what happens next? Markets are kind of jumping all over the place at the moment, trying to figure this one out.
Yeah, I mean, I think markets are really kind of buying in this idea that there's some rumors that maybe there's some something additional that's going to come out of this. It's hard to tell how much of that is wishful thinking. What we've seen is a really big jump in stocks related to consumption, so things like Haidilao, Trip.com, maybe just on that hope that you get more on, say, consumption vouchers out of China. We've seen a bit of that earlier this year. Maybe the Economic Work Conference gives us some more details on that front, anything on the fiscal side. So markets certainly are hoping that maybe there's a bit more to kind of help drive more demand from the Chinese consumer, which, as we know, has been a really soft spot this year, just as reflected in some of those, inflation numbers. So whether we actually get anything, again, hard to tell, but I think that's why there's just all eyes are really focused on what's coming out of this report.
All right, Jill Desis in Hong Kong, we thank you so much for breaking down that story. Of course, we're going to keep one eye on that. We're also keeping one eye on what's going on in South Korea. Some headlines crossing the Bloomberg terminal here. South Korea's opposition will file an impeachment motion on Yoon at about 8:30 a.m. London time. Now, the vote is officially on Saturday, but this is a move that is largely procedural. Nevertheless, we, of course, know that in light of the current president kind of sticking to his current position and pushing against that impeachment vote, this is crucial context.
OK, so we're certainly watching that one, as you say, Kriti, today and into the weekend. Let us talk about markets, and our Bloomberg executive editor for Asia Markets, Paul Dobson, joins us once again for a talk about markets in 3 minutes. And let's start with the China news flow. A lot of anticipation once again, Paul, about what we might hear then. I suppose the crucial thing is going to be the nature of the fiscal stimulus and how big it is and what form it takes. I suppose there's a risk we don't get that, though.
Good morning, Anna. Yes, there might be light on details, and that stands a chance of disappointing markets. On the other hand, there is some expectation that we should get a little bit more, maybe on the consumer side. Those stocks have been performing well today, maybe encouraging more spending, more travel. Some of the cities are already front-running that a little bit by handing out some coupons, and we're seeing some decent performance in equities today. On the monetary side as well, there's a lot priced in now in terms of expectations for further rate cuts. We've got very low yields, particularly at the one-year tenor, a reasonably steep curve as well, expecting those cuts to come in pretty hard and pretty fast by the looks of it, and that has been something that's been weighing on the yuan as well. Now, in the background, we've also got the sort of what is China going to do with the trade negotiations with Trump. They seem to have been lining up some sort of bargaining chips in the past week, and we just learned, from the most recent press conferences that there's a bit more openness to hold talks as well on that. So that could give the market a little bit of hope as well, and moderate some of the movements that we've been seeing across the currency space.
Paul, the word I'm hearing a lot this morning is hope. We hope that this is going to happen. We hope that that is going to be happening. How much do we actually know, and how much could change in January?
In terms of China, we await more details. I think in terms of monetary policy, we could see action as soon as this week. They've been pretty clear in telegraphing the idea that there would either be rate cuts or some easing of the RRR. So that may come before the new year, or, it being China on Christmas Day or on New Year's Day, who knows. But at some point soon, the market is getting ready for that. I think the rest of the policy details, the market would love a big bang, but it's likely to be more of that incremental drip feed. So there'll be excitement, then dissatisfaction, and that kind of cycle for a little bit longer, most likely. On the other hand, there has been something coming down from the top that there's a need for a little bit of a pivot, and the market is still attaching onto that for sure.
Paul, you're no stranger to the FX story, of course, in Asian currencies. The trade-off between the Korean won, the Japanese yen, and, of course, the Chinese yuan, as well as a function of the manufacturing process and the manufacturing relationship with the United States. Which country, given all the headlines, do you want exposure to right now?
Which country do you want exposure to? I think it depends. If you're looking in the FX space, it's very difficult to play it at the moment. I think that China is such a big influence and anchor for the rest of Asia that wherever the yuan goes is going to matter for everything else. I think if you're looking across the stock markets, Korea has nearly erased all of those losses now that it had from the political volatility, which is pretty interesting. People coming back in, looking at those valuations. China already has a lot priced in. Japan, so a lot of the gains already seem to have been done. So there will be stuff on the equity side, but also that currency volatility is going to be really crucial too.
All right, Bloomberg Executive Editor for Asia Markets, Paul Dobson, joining us this morning. We thank you so much. Let's get a quick check on some of the stocks to watch. We're about 8 minutes away, 7 minutes and change away from the open. I've got my eye on defense stocks. We've got NATO, some reports coming out that they may be considering the refinancing story, going from that 2% GDP rule to potentially 3%, something that we know that the Polish government has been pushing very, very hard for. So defense stocks, very much on my mind.
Rheinmetall has doubled this year, okay? One of the key elements as to why the German market is outperforming all the other markets in Europe at the moment, which seems so counterintuitive, given what's happening in the German economy. And we're going to talk about the politics and what is going on there. Let's talk about tech, though. Broadcom up quite strongly, AI chip story driving that stock. Adobe down quite sharply. We're watching that one in terms of the AI narrative folding through as well. SAP has been an amazing driver of the DAX this year. And look at the kind of numbers that it's been posting. It's up over 60% so far this year. It has been a key driver of this German market. Siemens Energy's been another one. You were talking about this a few days ago. 80% of sales for the 40 largest stocks in Germany are external. This is an external market. And you look at why it is pricing, therefore, what it is pricing in at the moment. Big defence theme coming through, that's being priced into the German defence stocks. Tech stock story, SAP has risen really quite strongly. So there's some really interesting names in here, but it's fascinating that the German market has been doing what it's doing.
Let's just have a quick word on BMW. Fascinating exchange on X yesterday between BMW and Tesla, which has got people excited about whether there'll be some collaboration coming there. On Tuesday, the German automaker applauding Tesla for its full self-driving assistance software, the latest version of that, terming it very impressive. And then we got a reply from Tesla just saying hi to BMW with a very nice smiley emoji. And so there's this little exchange got people excited about hopes that perhaps the two there might be a licensing of that technology.
That's the fly in the ointment for the German market. BMW down by 22% so far this year. Porsche's down by 22%. Volkswagen's down by 22% this year. The German car makers, the big drag on the German market this year.
We'll see if the markets react to it. I mean, there's some very nuanced stories, but it feels like a lot of news coming out of Germany. Of course, right now, DAX futures are down about 0.2%. Coming up, it is the opening trade. Futures mixed. Stick with us. This is Bloomberg.
It was the night before Christmas. Nothing was stirring, not even these markets. As you can see, we're not expecting very much right now in terms of the equity market open here in Europe. We saw a rally yesterday, both in the United States and in Europe. Europe went out here, the United States went out there. I'm not sure there's really much we can read into it. There's a few tech stocks overnight that I think are going to provide some interest out of the US. Here in Europe, Kriti, things feel fairly quiet as well.
I was going to make a Christmas reference, and you completely stole my thunder again. Anyways, green on the screen when you look at the futures picture. Eurostoxx 50 futures flat at the moment. Slight outperformance in France, underperformance in Germany. But Anna, as Guy was saying, nothing really stirring when it comes to these future stories.
Yeah, I think we're going way too early on these Christmas references, but you know we got a lot of days left. Let's have a look at some of these stocks to watch this morning and sectors in focus. Defence stocks certainly very much in focus. We have, of course, talked about NATO spending a lot. When will we get detail on how some countries get to 2.5%? Should it actually be 3%? That's the latest conversation coming out of NATO, it would seem. We'll get more details on that story shortly. Tech stocks also in focus, not exactly because of clear read across from Adobe, but just in terms of sentiment and anything that's attached to the AI trade. Might the Adobe numbers, which came in lower than expected, set people off worrying a little bit about startups in AI and what they're going to do, eating at the heels of some of the bigger players in the AI space. That seems to be the way that some of these numbers from Adobe have been interpreted. And let's go to UK retail as well. Citi saying that Currys shares look as if they could rise this morning after the electrical retailer revealed sales returned to growth and delivered an earnings beat for the first half. So we'll look to see if we get any upside from Currys at the start of trade then, Guy.
Trading into Christmas looking all right as well, certainly in line with expectations for Currys. Let's talk about what is happening in these markets as we anticipate this Thursday open. Not a great deal anticipated in terms of movement. Single stocks, there could be some interest here. So we're expecting a little bit of negativity, but I would say actually probably a fairly flat market. FTSE 100 is absolutely flat as a pancake right now. We're up by 0.1%, struggling to hold that a little bit. Maybe we'll continue to remain in positive territory, but I wouldn't hold your breath. Stock 600 out of the gate with a very exciting 0.04%. I still think my nothing is stirring story probably fits the bill. The IBEX is down a little bit. The CAC is expected to be reasonably flat. We await political news there as well, but actually maybe a little firmer than actually most of the other markets, up by 0.4%. We await the DAX. While we await the DAX, I would urge you to read Michael Masika's fantastic piece this morning talking about why this market has had such a strong rally thus far this year. Kriti, what else are we watching?
Well, we're certainly seeing some outperformance when it comes to some of the bigger kind of players here, your sensational six, your core six. That's what's moving the market this morning. LVMH is your biggest index contributor to the upside. But then, Anna, we have a little bit of a sprinkling, if we will. That's a broader conversation of some of the commodity names. Shell is kind of your number 2 biggest index contributor, but I'm not seeing a consistent commodity trade this morning.
No, and things look a little divided, don't they? Roughly half the sector's going higher, or just more than half the sector's going higher. Just a little less than half of the sector's retreating, and consumer products seem to be at both ends of the spectrum. So we've got the consumer products and services sector as the best performing, and you were talking about some of the luxury names in there. So Bruno Cucinelli is higher, Christian Dior higher, Burberry higher. Is this all to do with Chinese consumers going out with vouchers and spending them? That could be what is driving that. We don't know if they're going to get vouchers, but that seems to be one of the news lines being pursued through the Asia session as we wait for the conclusions from the Works Council. To the downside, the more regular stuff of life, we have Unilever and Carrefour, Reckitt Benckiser, those kind of names trading a little bit weaker this morning, but there's not much in it. We're waiting for further details on the US inflation picture and the ECB, of course.
Vouchers. Is this the equivalent to sort of checks that were handed out during the pandemic to US consumers?
Yes, maybe. It's like getting in a helicopter and throwing money out of it. Isn't that the old metaphor people used to,
or vouchers.
Used to talk about?
Is that what you do on the weekends? You get on a helicopter and you just throw money?
You've got his weekend.
You have a very different perception of my weekend than I do. Unilever's down quite sharply, down by 0.9% this morning. Nestle yesterday. Nestle was at a 52-week low yesterday. So some of those consumer names, those staple names out of Europe have been under real pressure recently, and that continues today with Unilever soft. Reckitt Benckiser down by 0.6% as well.
We should very quickly mention that Italian bonds have also seen a pretty decent drop this morning. The 10-year yield higher by about 5 basis points. We're looking at 3.24 on that 10-year yield. It's still unclear what's driving that move, but something that we're going to be monitoring throughout the rest of the show. Let's get a little bit more analysis this morning. Sonia Loud, CIO of Legal and General Investment Management, joins us around the table. Sonia, pleasure to have you on the program. I feel like we're talking about so many different topics this morning, so I'm gonna start off very generically. What do you think is driving markets into year-end and into 2025?
So into year-end and into early next year, it will clearly be fundamentals. You know, you will see the same obsession around central banks. The ECB will be in focus today. We've at length talked about the Fed and the potential rate cut cycle there. So it is really focusing on the data points that the market can take for granted, so to speak, and that are real and hence can drive a little bit of the narrative. The reason why I've been focusing so much on early next year is because then, of course, we will see political events taking over, and I think that is what makes a 12-month forecast so incredibly difficult, because we're talking about binary decision-making. And let's face it, developed markets are not particularly good in pricing political risk. I think we all have to ask our emerging market colleagues on how you do this properly, because they will, of course, have this as part and parcel of their overall analysis, whereas we have taken political risk normally as a side event to fundamentals. But given that we're looking at policy decisions from governments driving fundamentals, that turns everything upside down.
So what's the roadmap there? What's the gut instinct? Do you trade the volatility? Does that mean shorter bets that you kind of get in and out of? You pursue liquidity, or does that mean staying on the sidelines until you get clarity? Which one is it?
So we're relatively neutral risk, but you're absolutely right. If you look at duration and the positioning within government bonds in particular, you've had quite a few trading opportunities this year. It wasn't a smooth journey. You know, there was quite a lot of volatility. If you just consider how the market pricing for the Fed curve and for the dot plot has been changing, it's phenomenal. And of course, we are now still expecting a number of rate cuts, although it's far more subdued than what it was back in September. But, of course, even that can change dramatically depending on decision on tariffs, decision on immigration. Of course, fiscal and tax cuts will probably only appear at the end of 25, so the market will have to wait how this is all coming along.
Why do we think that developed markets are bad at pricing political risk? I look at what's happened since Donald Trump has been elected. It's been fantastic. Everything's fantastic. It's amazing.
I know.
Is that not real?
And it seems the market, for the time being, is very much buying into the good pieces. Right, so because he has promised to extend the tax cuts, there's potentially even more. The fiscal support is there, so there's a lot of positives in there that the market currently is hanging their hat on and say we're going with
political risk. This is just political
support.
Yes.
Until we come to tariffs and, of course, immigration, because we should not forget that immigration in particular was growth supportive last year. If he wants to reverse it, and, you know, I know there's a lot of logistical questions, how quickly, what you can do, he can definitely address the borders and shut the borders, as he called it, straight away, which means, you know, the supporting element we've had last year, and we've talked about the 3 million people, will immediately be removed. And likewise, tariffs, you know, we've heard Janet Yellen earlier, it pushes inflation upwards.
But there seems to be this view amongst so many people I'm talking to at the moment that Trump is transactional. That if something bad happens, he'll just change course. That if it doesn't work and the markets go down, he'll deliver a different outcome. That seems to be everybody's narrative at the moment. Is that incorrect?
It is very much looking at the playbook from 2016. The fundamentals were very different in 2016. Valuations were very different in 2016. And I think the world didn't quite know what to expect from a President Trump. And it seems that right now we're literally going into the same playbook. But to our mind, he has received a very different mandate. Whereas in 2016, I think he's tried to find his way through the establishment in Washington. I think you see from his selection of his running mates quite clearly that he's aiming for a different proposition this time round. And I think the market is honestly in that context waiting, but is definitely taking the positive playbook from 2016 and potentially ignoring that where we are in interest rates, inflation, corporate tax rates, frankly, and all the other areas. We're at a very, very different part of the cycle. And hence the additional stimulus might be far more difficult to come by than what it was back in 2016. And if you then look at valuations, you have to wonder how much more you can get out of it without running out of road.
OK, and so in that context, Sonia, you might start looking at private markets and thinking, what will we find there? Talk us through your expectations for private markets in 2025 and what kind of allocation people should have, you've got, to private markets, because this seems to be increasingly a conversation that we can't avoid around this desk.
Yeah. No, absolutely, because you will not have any client meeting anymore where the context of alternatives and privates will come up for very good reasons. They are providing a level of diversification that, I mean, we have always talked at length in public markets where you find those uncorrelated asset classes that will help you to balance potential volatility. And here, private markets will help a lot in offering exactly this. Now, the questions, of course, that we are having is if you look at the amazing growth that we have seen across the alternative spectrum, you know, if you look at the price discovery mechanism where there were quite a few questions, why have public markets corrected so dramatically compared to some of the private counterparts? But at the end of the day, we are expecting this growth to continue. There is, of course, always the risk. We talk about alternatives. These are very distinct asset classes.
Yes, very different
and we have to be very careful not to summarize all our assumptions in one go. But if you look at what clients are looking for, then areas of infrastructure and private credit are probably the ones where we see most interest and logically aligned to structural long-term themes which could drive this.
So it was really interesting. We had a conference on Monday that we attended, and Jenny Johnson was there, and she was talking about how some businesses, because of these long-term themes around investment, some businesses were actually forced or advised or decided to go private and to make investments in the sort of private space and then, you know, maybe consider relisting again, as if public markets are not very good at allowing the time horizon that these businesses need to make investments right now. And that's what we hear from a lot of people who are pushing private assets, of course. But that, you know, you'd expect that. Is that really the case, Sonia, that the public markets are being found wanting in terms of the time horizon that they allow senior executives?
Yeah, you're definitely seeing that. In particular, given that we're talking a lot about the energy transition, and this is an area where you increasingly see that, of course, private markets are probably providing a better framework. Why am I saying this? Because public markets do struggle in pricing or forecasting 10, 20 years in a way that would then allow individual investors right now to see the benefit. So there's a real disconnect, and there would be quite a few companies that have said, we believe we have been doing the right thing and our long-term strategy is properly aligned with, let's say, a net zero pathway, yet the stock market or the bond market doesn't give us any credit for it. So there is something in there that probably is better reflected in private markets, coming back to the price discovery mechanism. So you might find a more beneficial setup there.
The era of buybacks, dividends, driving so much of corporate Europe, is that era over?
I think corporate Europe will look increasingly what level of growth they can deliver. And if you are in the exec or on the board, you really have to challenge yourself whether the way you allocate capital is in the best interest of all stakeholders. And as such, you will clearly find with the European growth profile being as subdued as it is. I know you mentioned earlier that, of course, in Germany, for example, the vast majority of revenues are actually generated outside of Germany. But still, you have to make sure that the growth trajectory in your journey is commensurate with your ambition. And then, there will be always a balancing act, how much share buyback and dividends, which will probably drive share prices more in the short term, will really allow you to deliver the long-term growth profile that attracts global investors.
I hear you, but does it matter? If you have outperformance out of China driven by these stimulus talks, if it indeed does yield results, and economic kind of outperformance out of the United States, and that's what's driving your bottom line, does it matter if Europe as a region is underperforming, if your exposure is outside of Europe?
No, it doesn't. But of course, if you're a French luxury goods manufacturer, it did matter that China didn't do quite that well, right? So you have to make sure that your diversification will allow you to have a less volatile growth opportunity than what we have seen in some of these companies being reflected. So hence, coming back to the capital allocation and your overall global strategy, you want to make sure that you are well diversified in order to avoid any of those shocks.
Comes back to that golden rule of investing. Sonia Loud, CIO of Legal and General Investment Management, we thank you so much. As we were speaking to Sonia, we did get some headlines coming out of Italy. The Italian consolidation story continues. Getting the official nod, Banco BPM is, from the Italian competition body authorizing their Anima bid. We should put it into context, and I have a map pulled up on my Bloomberg terminal, because there's no way to really do this without one. They already have a 22% stake in Anima. They also are trying to bid for Monte Paschi. On top of that, UniCredit is trying to bid for Banco BPM and get all that exposure
and
to the small
Agricole
banks.
Potentially as well.
Potentially, and that French consolidation story. Looks like this morning, though, Banco BPM higher by about 0.4%. It was higher earlier, so it paired those gains, but that's something to watch.
Is this a kind of poison pill? If they get this acquisition, does it get harder to take it over? Does it make it harder for UniCredit to step in and deliver on this? Because the indication was that maybe UniCredit didn't want that business.
Yeah.
So if it acquires that business, just complicates and muddies the story, doesn't it?
I think what I'm so confused about for Banco BPM, and this is a longer conversation, but is they have so many, and even Anima has so many different bids for so many different companies. They're in the middle of like 4 different deal transactions that may or may not come to fruition at the moment.
May or may not. Seems to be the story there. Let's talk about the core 6. What is happening right now? Let's take a look at what is happening with luxury. I think a very good today, a good day today. LVMH is up quite strongly, as you can see, up around 1%. Names like Cucinelli are doing even better this morning, so we're watching some very strong numbers coming through there. Cucinelli raising its guidance, so that's also helping out the luxury sector. You're seeing a strong performance, potentially also being driven by some news out of China. Ferrari's up quite nicely as well. ASML, the chip story, seems to be back a little bit. Nestle down another 0.2%. Hit a 52-week low yesterday. That continues today. Nestle now trading at 74.62. A real spread there in terms of the performance we're seeing. Novo also at the other end of the story, down, other end of the board, down as well by 0.7%.
Let's talk about the defense story as well. We are seeing green on the screen when it comes to those defense stocks. I should warn that the entire market seems to be higher, so I'm not sure if this is necessarily driven by the news we got out of, say, NATO, for example, talking about increasing their defense spending as a function of their GDP. Remember, they had that 2% rule. They've had some political pressure, specifically out of Poland, to push that up to 3%, maybe even higher, and now that's being taken very, very seriously. Perhaps a tailwind to that defense story.
Can I just point out that Juventus' stock is up by 8.4% today? They beat City 2-0 last night, I think.
Is that a defense story
It's nice to see. Well, the defence was quite good.
Yes.
The attack was even better. So yeah, a little sports to financial markets story going through there. In terms of other news, I hadn't actually spotted this one, so let's talk a little bit about what's happening with Hayes this morning. Its stock is down by 5.25% at the moment, 5.3%. This coming after an update that we have seen coming through this morning. Material positive impact, though, on free cash flow from 2026. The outlook may be actually a little bit interesting this morning. I need to get some more details on what is happening there.
That looks a bit grey.
That one has been thrown in.
Well, 5% is still a pretty substantial move. Another major company that's seeing a pretty substantial move is Grifols. This is a deal that I'm a little obsessed with here because they recently, basically Brookfield just recently walked away from Grifols. This is a major Spanish company as well. They are now talking about a €1 billion debt placement after that walk away. The shares are rising about 6.4%. One of the big concerns is that this is a family-owned business and they were going to be taken private. Now it looks like to kind of tread a little bit of water, they are having that debt move. Something that the market, by the way, really likes. 1.3 billion, I should be specific.
We've mentioned that NATO story a few times this morning, so let's get to that shortly. Coming up on the programme, we will discuss new NATO goals on equipment production, national defence spending and more. That's next. This is Bloomberg.
19 minutes into the session, I'm struggling to get excited about the numbers that you see on the screen in front of you. The Kekirons is up a little bit more. The takeaway today is that luxury names are actually doing fairly well. There is a China read across. Actually, basic resources aren't having a bad day either. But we are, I think, looking for a sense of direction. The Fed cut rates yesterday, or at least the market priced in the Fed cutting rates yesterday. We're waiting to see what the ECB has to say a little bit later on. Let's turn our attention to a conversation we've been having with the outgoing US Treasury Secretary, Janet Yellen, talking about a softer global oil market and saying that may present an opportunity to target Russia's oil revenue. Janet Yellen has been speaking to Bloomberg's David Gura about ongoing efforts to impair President Putin's ability to wage war in Ukraine.
We never preview sanctions, and we've constantly been tightening our sanctions on Russia. Our overall aim is to impair Russia's ability to continue conducting this brutal war, to try to deny it the military equipment. It needs to be able to do that, and we've taken a variety of steps to do it. But we have been focused since the outset on Russian oil revenue. It's a critical component of the Russian budget, and we've been looking for creative ways to try to reduce Russia's revenue. One of the most creative policymaking things that I've been involved at during my career occurred here in Treasury when we were able to devise a way and convince our allies to join us in this, imposing a price cap on Russian oil, which was a way of avoiding price spikes when the war started for oil, and actually succeeded in keeping Russian oil flowing into the market. So we continue to look, of course, over time. While these sanctions have been effective, Russia has invested a lot, its own fleet of ships to carry its own oil. We cut it off from allied ships, new insurance that have been costly to Russia to have to make those investments. Now, what's unusual about this moment is that the oil market seems to be well supplied.
Prices are relatively cheap.
Prices are relatively low. Global demand is down. And there really has been an increase in supply. American firms have stepped up. We have vastly expanded oil production. OPEC countries like Saudi Arabia have excess capacity at this time. So the global oil market is softer, and that creates possibly an opportunity to take some further action.
US Treasury Secretary speaking to Bloomberg's David Gura, talking about how the oil industry is feeding the Russian war machine, turns our attention to what is going to be feeding the European war machine. NATO said to be potentially planning new targets for member countries to produce more weapons, vehicles, ammunition. This is the group weighs the new Trump presidency and how Russia's invasion of Ukraine will ultimately end. There's talk potentially of the NATO target going to 3% of GDP. That discussion appears to be increasingly live. Bloomberg's Ollie Crook joins us around the table in London this morning. Walk us through how Europe spends more and what it spends it on.
Yeah, so listen, Guy, this is sort of interesting because we're thinking about this all in the context of a great many of sort of things within Europe. Just left Brussels, where we're talking about the financing of defense, and really they're trying to throw a lot of things at the wall and really see what sticks at this point, because we don't really have a cohesive approach of how this defense spending is going to be boosted and what it's going to look like concretely. So one of the proposals now being discussed by NATO is boosting that target to 3% from 2%. We're bearing in mind that most of these NATO countries only hit 2% basically this year or very, very recently, and then getting something close to quotas or targets in terms of actually producing this kind of hardware and military hardware and these capacities, air defense, ammunition, tanks, all of these sorts of things. And why 3%? The U.S. spends 3.5% on NATO. And, of course, now we have Trump coming in. It has been one of his big gripes with the Europeans and, frankly, something that he's been completely validated on, at least in his first term as president.
Where does the money come from?
And this is going to be the big question. As we talk to the finance ministers of the last couple of days, you have some resistance, obviously, from the sort of traditionally frugal nations, from Germany, from the Netherlands. But it's interesting. We also spoke to the Danish prime minister, who, admitted to being very sort of frugal in the past, but actually open to putting things on the table. I think the problem is you have all these different concepts, this 500 billion euro fund. You have these special vehicles where potentially electively countries could join into a sort of bond issuance for collective defense. The problem is for these countries, in order to get them on board, they need concrete proposals in terms of what this money is actually going to be spent on. Is it going to be a sort of joint sort of air defense system? Is it going to be maritime? Where are these things going to actually go? There needs to be a concrete plan to hook into. And that is, I think, where next year we might get something sort of interesting from the Polish Council presidency of the EU, because they really want to make sort of defense number one on their agenda. And as we know, we spoke to the finance minister yesterday, already their spending next year to NATO is going to be about 5%, the highest of anybody in the alliance.
Yeah, it'd be interesting to see how much the planning around who does what is coordinated or not, Ollie, on that front. And in terms of where they buy it from, if there is a plan, as some have suggested, like Mario Draghi, for example, that these things should be done in a bi-European way, if there is a plan for that, is there going to be enough supply within Europe?
So this is certainly a plank of basically what the competitiveness regime is going to be, but also in terms of defense is trying to get that spend up. But if you just look at the market caps of these companies, I mean, Rheinmetall, after a 540% surge since the war in Ukraine, is a sub-30 billion euro company. We have, Raytheon is at 160 billion. You have Lockheed at 120. So they have a lot of work to do, and they need to figure out basically how big these order books need to get in order to actually boost that capacity. We went to Norway to go to Kongsberg, where they actually expanded that missile factory earlier this year. That plan began before the war in Ukraine. So this is really a long-term plan.
Yeah, and we certainly heard from the UK government as well, talking about spending more on defence and their plans there and linking that to the economy, just as the Europeans look set to do then. Oliver Crook with the latest on NATO. And sticking with defence, don't miss our exclusive conversation. In fact, Oliver bringing us this tomorrow with the CEO of the German defence company Hensoldt. That's tomorrow at 8:30 UK time, ahead or in link to the Capital Markets Day and strategy update.
What we're going to do next, we're going to talk about a conversation I had with the CFO of the travel tech company Flix, talking about why the company didn't go public earlier on this year and took the private option. It's all part of the conversation around the CFO series we've got. That is tonight. This is Bloomberg.
This is the opening trade, about 30 minutes into today's session. Green on screen when you look at the stock market, but the real juicy bit is what's going on in the Swiss economy at the moment. The SNB cutting the policy rate by a whopping 50 basis points down to about 0.5%. The estimate was to 0.75%. They are already going on saying that they're prepared to intervene in currency markets if needed, which, by the way, you are already seeing some major weakness across the Swissy against the dollar, the euro, the pound, even the Japanese yen.
The problem is that they've got a real issue that they keep cutting rates and the Swissy keeps getting stronger. And the reason it keeps getting stronger is the political turmoil that we're seeing elsewhere. And this is obviously having a major impact on Euro Swissies, which is what they really worry about. So they've got to do intervention. It looks like they're back to that playbook. They can keep cutting rates if the market isn't responding. So what else do? You intervene, you support the market. But we're back to the playbook.
Yeah, and as you can see on the screen, as you were mentioning, Kriti, the euro strengthening as a result of this decision, Euro Swissy rising 0.6%. The SNB, no stranger to throwing us curveballs, were the lines I read from Venram this morning. And this seems to be the case once again. They surprised us with a 50 basis point, they surprised us, investors, with a 50 basis point increase to mark the start of the tightening cycle in June 2022. Then in March of this year, the cut was a big one, and it came earlier than expected. So, and this is a new president at the Swiss National Bank. Doesn't seem to be adverse to giving the markets a surprise.
But what is it? So they've cut by 50 basis points, so that's a surprise. So you're also getting a shock reaction in some ways. The market wasn't positioned for 50, though some people have been talking about it. How long does that move last? And is this a reaction to the 50, or is it a reaction to the stronger language, willing to be active in the FX market? Which of these two factors, or the combination of both, are moving the currency? I suspect it's probably a little bit of both. The 50 is obviously a surprise, but how long does that 50 last? Say we get some more chaos in France. Does that undermine the 50?
I was literally going to say, is this an insurance cut at the end of the day? Is that what that extra 25 basis points is? In that if you do get that bid for the kind of political hedge that you were referencing with the Swiss franc, is this the extra dry powder that a lot of economists, including Bloomberg Economics, have said needed to be there in case come January we need that extra room to maneuver?
And we've talked a lot about the weakness in the inflation in Switzerland, and they're talking about how this is being driven mainly by domestic services. So reminding us that, given we talk a lot about the international context of the Swiss franc and their decision-making, there is this domestic driver.
They're at 50 basis points now. They're not far away from zero.
They did half of what they had left, if zero were the lower bound, which we know it isn't.
But it isn't. They've already indicated that isn't the case. So really interesting move. Looks like the SNB is going to be having to step up on the intervention front. That certainly seems to be the narrative coming out this morning, for the 50 basis point surprise being delivered. We'll see what the ECB has to say a little bit later on. Let's turn from central banks to capital markets. Tonight sees the European premiere of Bloomberg's latest episode of Chief Future Officer. For this episode, I went to Munich to visit the CFO of the travel tech company Flix, which has become the leading long-distance bus operator in Europe and in the United States. If you've never seen one of those green buses, which maybe you have here in Europe, if you're thinking about the United States, they own Greyhound. Now, earlier this year, the company pivoted from a planned IPO and instead sold a 35% stake to private equity giant EQT and Kuhne Holdings at a valuation of over $3 billion. Now, this is just yet another example of private markets winning out over public. So I spoke to the CFO, Christophe Debus, about how that decision came about.
We have always seen an IPO only as a financing event. It was never a strategic goal. Public markets, they don't forgive. It's all about performance, and you have to live up to your promises. We have introduced a culture, we deliver or we over-deliver.
Then the company dramatically changed course. Postponing the IPO, Flix sold a 35% minority stake at a reported €3 billion valuation to investment giants EQT and Kuhne Holding.
What led to that pivot? What was the decision-making behind it?
The markets were not ready for IPOs. At the moment, IPO markets are so depressed that you only do an IPO, I would say it, if you really have to. The opportunity came up, and we had the opportunity to speak to EQT and Kuhne and realized that for the time being, that's the much better option. And then we worked very, very hard to deliver that deal.
It was not one or the other, and one was a bad option. It was just two good options, and I just chose the better one.
Think an IPO could still be a possibility?
You know, we built that company for generations. I think this is really a company which has the potential to be here still in 100 years. And on that path, I think one day it will end up at the public markets. That's my conviction.
One day that will happen. But Andre, talking about the fact that he chose the better option in the short term, that seems to be the private play at the moment for so many businesses. So it's really interesting. There's another example of a company that has decided to go down the private route. If you want to get more on this, obviously, you can watch the entire episode. Plays out for the first time here in Europe, 6:30 p.m. tonight.
That's really interesting, that decision-making, the thought process as to why you go public or you go private. And that takes us nicely into our next conversation. Let's bring in Silvia Viviano, who joins us from UniCredit, who's head of equity capital markets at UniCredit. And Silvia, we wanted to talk to you about IPO markets, about equity capital markets within Europe. And we were just hearing that conversation with Flix there, talking with a CFO who's had to make that decision. Do you go down the private route or do you go through the public markets? And the decision they made in that case was that public markets were just not ready for IPOs. Has that changed? Is that changing through the latter part of 2024 and into 25?
Hi, good morning, everybody. I think listening to Christoph, Flixbus is a perfect example of what we saw in 2024. Private company, very performing excellent, very well, delivering in terms of results. But then you have two options, and actually they've been lucky enough to have two options, right? That's actually a testament of the quality of the company. And the reality is that investors were there, but probably they were questioning on some of the aspects of a company which is still young and growing a lot. And at that point, the reality and Flix is just one example where we saw many other cases that were basically at the same level or were doing the same process of Flix. They decided to actually to go private and to wait for more conducive capital markets environment and, let's say, judgmental investors willing to actually invest and take a bet also on high growth companies. The reality is that it hasn't changed really through the second part of 2024. When we talk after summer, reality is the election, the US elections, they were there to actually put a pause on the IPO market. And so we haven't really seen an increase or a pickup of activity in the IPO market in the second part of 2024. We do see, however, a bit of pickup in terms of pipeline for 2025.
OK, that's interesting, because so we're talking here still about a cycle, Silvia. I wonder if there's something more structural going on here as well, and that is the rise of private markets. And we've been talking a lot at the beginning of this week with people who said public markets are just not very good at allowing businesses to invest for the very long term. And therefore, a number of companies either going private or staying private longer if they have a requirement to do a lot of investment in infrastructure, in decarbonisation, for example. Do you think that the public markets are just being found wanting right now?
I think you mentioned something very relevant, and I think it's a bit of a cycle here, in the sense that we are in a situation where, because investors and the market is so demanding, so they want more paper to come, especially from Europe. They want more companies to get listed. But then when we go and we present good candidates, they start questioning a lot of the characteristics and some of the key metrics and of the expectation business plan of the company, etc. So, private markets instead has been much more diligent in trying to analyze and actually work alongside the management to understand better the future and the business plan of these growing companies. So I think we just saw a split, which I don't think is a structural change of the public markets. I think it's something we saw in the past. Yeah. But it's just a matter of the result of what happened to the recent IPOs and some big trades that didn't perform very well.
Silvia, what can government do? What should government do to make this better, to make this work in public markets? In the UK, we've heard messages coming from the Chancellor of the Exchequer, Rachel Reeves, talking to regulators, trying to put a more growth-focused emphasis on what they are delivering. Do you think this is a problem that regulators need to solve rather than investors?
I think it's the first time I've been working in the equity capital market for so many years that I do see an alignment of all the different public and private, let's call them forces, in terms to try to find a solution in Europe for the equity capital markets. If you think the report issued by Mario Draghi on the European competitiveness, the reality is that he defined, or he says, we need to be careful because here we have the risk of slow agony. And I think it's very, it's a very precise point. The government and actually all the public bodies, they need to do something in order to try to, prevent the lack of innovation that we have in Europe, the fact that we have so many different capital markets available. They definitely need to do something at a broader level, at a higher level, in order to facilitate and make the European capital markets more open for business and actually, more, let's call the investors friendly and issuer friendly. That's for sure a must.
Sylvia, if not London, and if not the United States, then where? And basically where I'm asking here is, does Paris, does Frankfurt have a fighting chance in terms of creating kind of these more liquid markets that you're referring to? Are you starting to see that appetite? For a moment, I felt like we did in Paris, and then it kind of disseminated. Where do we stand on European capitals becoming that next IPO hub?
I think every single European market right now, Frankfurt, Paris, Milan, Amsterdam, they are really trying to make, I don't want to say rules easier, but to make it, again, easier for the issuers and also more appealing for investors to invest. As of today, Kriti, if you ask me, I don't think anyone has yet achieved the final result. So is there any specific capital markets in Europe which is winning? I don't see the result yet, but I do see for sure a concerted effort in order to try to achieve this.
Sylvia, Christine Lagarde was talking about this the other day. She was talking about just about how many venues there are in Europe that you can trade equity. Is that the other problem as well, that we just simply have too many? If we talk to Euronext, if we talk to the London Stock Exchange Group, should we be saying to them, why aren't you consolidating? Should government be pushing for consolidation? Don't we just need a few big exchanges here in Europe that maybe have the heft and the capability to be able to deliver a capital markets that Europe needs?
It's a very tough decision. It's not an easy answer to give, but my personal perspective is that, we need to make things easier. And in Europe, it's too fragmented. And investors, especially US investors that are used to a much simpler system and infrastructure in the US, I think they can see the difference and they struggle a bit. We are basically fighting or competing among each other within the European Union. And for sure, we are not helping ourselves.
Sylvia, we're going to wrap it up there. Thanks for joining us. Perfect timing. Really appreciate it. Sylvia Vivano, Head of Equity Capital Markets, joining us from UniCredit. What are we going to do next? We're going to go to Paris. We're going to get the latest on the political impasse. We are waiting a new Prime Minister. When does Emmanuel Macron announce a name? We think by the end of play today. Is that realistic? We'll find out next. This is Bloomberg.
Welcome back to the opening trade, 8:46 in London. We see very modest gains across European equity markets today, and we're waiting for crucial data out of the United States, PPI. We also get the ECB rate decision. We'll come to that in a moment. US futures down by 0.2%. Within the last half hour, we've had a decision from the Swiss National Bank, so let's get to that conversation. The SNB has surpassed economists with a 50 basis point cut to interest rates this morning, so surpassing those economist expectations. Bloomberg's Jana Randau is in Frankfurt monitoring what's going on in Switzerland, though. And Jana, how do you read then this SNB decision? Because it clearly has weakened the Swiss franc, and they've suggested that they're prepared to intervene in currency markets further if needed.
Yes, definitely proves that the SNB is always good for a surprise. It was that way under the old president, under Thomas Jordan. And it is true for Martin Schlegel, who recently took over and is about to chair his first press conference, actually. So indeed, a bold move, especially considering that the policy rate now is at 0.5%, so not very far away from that zero line. And that has to do, of course, with the fact that inflation once again proved weaker than expected. The SNB predicts inflation to be just 0.3% next year on average. While that's still in line with their target, so the SNB has a quite wide range. It says inflation needs to be under 2% and positive, so 0.3 in that sense is still in there, but of course at the very low end. So a bold move to make an entry for Martin Schlegel for sure.
Yeah, absolutely. Jana, is returning to zero or even negative rates potentially on the table? Is that something people are talking/thinking about?
Yeah, I mean, there are some economists that have raised that chance. Markets are looking, at that zero threshold. That being said, of course, a lot will depend on what's happening around Switzerland. It's a very open, trade-reliant economy, so export demand is very important for them. But getting back to the policy thing, negative rates is a very controversial tool in Switzerland, especially after the last episode. Which was a very long period of time with very, very negative interest rates. The SNB got a lot of pushback from banks, so that tool is not very well liked. And you mentioned it, they would probably go for currency interventions instead. The statement says they're ready to do so if necessary. So that's probably their first choice if they have to go that way.
Jan, are interest rates having any impact on the currency? I keep seeing the SNB cutting rates and I keep seeing the currency go stronger. Is intervention really, therefore, the only tool they have at their disposal if they seriously want to limit the appreciation of the franc?
I mean, it's the one move that lasts you longer because it's something that you will do and repeat, right? An interest rate cut, of course, has implications on the currency, but with time, that change goes away as markets reprice expectations and ask themselves, what is the SNB's next step? So if you want a lasting impact in market, then you need to make that happen somehow, and surely interventions is something that keeps you in the market for longer.
Yeah, I suspect the market is now wondering what else is in the toolbox and how deep that toolbox is and how wide-ranging it could ultimately be as well. Be interesting to watch how the SNB responds over the next few weeks and months. Jana, thank you very much indeed. Jana Rando joining us out of Frankfurt. Staying in Frankfurt, the ECB holding its final policy meeting of the year, widely expected to deliver fourth rate cut of 2024, another 25 bips anticipated. Lizzie, that all it seems to be in the price right now. Set us up for a surprise. Lizzie Burden, by the way, in Frankfurt.
Well, I can't promise you, Guy, that the ECB is going to follow in the footsteps of the SNB today, but I think they'll be thinking about it at least. Think about everything that's happened since the last meeting. You've had the collapsed governments in France and Germany, Donald Trump being re-elected, the euro area very much in the firing line for his tariff threats, but none of that is likely to derail the cut, but it will likely muddy the forecast. So we'll get numbers out to 2027 today. I'd expect them to lean more on scenarios than a base case, given all of the uncertainty. And you could see downgrades to growth and inflation because the outlook has darkened since the last meeting. You'll remember that PMI in November. And at the last meeting, you had Christine Lagarde saying that the inflation risks were tilted to the downside. Maybe we actually see that in the statement this time. Further out, you've flagged this, Guy. There is this big debate about where neutral lies and whether to go below it, how far to go below it. Economists reckon rates will settle at 2%, traders reckon 1.75%, but it all comes down to this debate of how much monetary policy can actually do to deal with Europe's economic woes, as so bluntly laid out by Mario Draghi. You've got poor productivity, a lack of skilled workers, a lack of financial integration. How much can cutting rates do about those issues? The likes of Isabel Schnabel would say not much, and that's why the Hawks reckon they don't need to, or they should start cutting rates. They should stop cutting rates sooner.
All right, Bloomberg's Lizzie Burden joining us outside the ECB from Frankfurt. We thank you so much. Well, full coverage of that rate decision due at about 1:15 p.m. London time, followed, of course, by ECB President Christine Lagarde's news conference at 1:45 p.m. London time. As we were speaking to Lizzie, we got some headlines crossing the Bloomberg terminal. Romania and Bulgaria getting the EU nod to join the Schengen border zone at a time when there's real division within Georgia, within Romania, to do that, to get closer to the EU.
What's Schengen zone? Germany in September, I think, backed away, put extra border controls in place.
There were border controls. Yes, certain borders of Germany didn't look very much like they were in Schengen. So, yes, whilst this might be a sort of step forward on that integration story, there are many reasons to suspect that things get difficult We'll watch geopolitical developments in the Middle East carefully.
Its value maybe has been downgraded a little bit. We're, of course, watching what's happening with French stocks and bonds. Investors, of course, are waiting Emmanuel Macron's decision for Prime Minister. Who's it going to be? We're expecting a decision by maybe the end of play today. Is that realistic? Bloomberg's Caroline Conan in Paris. Are we finally going to get a deal tonight? Is the left wing going to back a candidate? What are we looking at right now?
Yeah, that's what we're expecting. In fact, the President Emmanuel Macron is in Poland today for a state visit, and we expect the name of this new Prime Minister by the end of the day when he comes back from Poland, probably before the 8 o'clock news in France. But I think the most interesting political shift that we've seen over the past few days is really the slow death of this NFP left-wing alliance with the socialists, the communists, the Greens, going to meet with President Macron, showing they're willing to compromise. The first secretary of the Socialist Party, Olivier Faure, appearing on French media over the past few days, saying they don't want to block the situation anymore. What they're asking is that the new prime minister doesn't use the 49.3 article in the constitution to bypass a vote in parliament in the future. Of course, the head of the far left, Jean-Luc Mélenchon, who's refused to take part in those discussions, has called for outrage, saying that the socialists have no chances if there are snap elections next year to be elected because they need the support of the far left. And in fact, Macron has kind of been reaching out as well, saying that he's hoping there will be no parliamentary elections until the end of his mandate in 2027, kind of meaning that, you know, not scaring the socialists who may think about not being re-elected without the support of the far left.
And just briefly then, Caroline, who are the names, which are the names that we're watching for? Have they evolved?
We still have François Bayrou, the head of the centrist Modem Party, 73-year-old, currently the head of some independent planning advisory that was created by Emmanuel Macron during COVID. The good thing about him is that obviously he can also talk to the center-left, even though Olivier Faure, the first secretary of the Socialist Party, has said that he would not necessarily be the best choice because it is a bit of continuity of Emmanuel Macron. But Bayrou is also not at odds with Marine Le Pen because he has been supporting the proportional system in parliamentary elections rather than the two-round system, which is something that Marine Le Pen has been asking for years. And of course, you still have the name of Bernard Cazeneuve, the former socialist prime minister of François Hollande, always coming back. We already spoke a lot about him last summer. Maybe he would be a bit more convincing, a bit more like a rupture from Emmanuel Macron for the socialists who are showing they're willing to compromise.
Caroline, thank you very much. Bloomberg's Caroline Conan with what we need to watch out for today. And that's certainly one of the things we're watching for an ECB rate decision, watching for the naming of a French Prime Minister, and we understand that comes today from our reporting. Also watching for the President-elect and what he's up to.
Yeah, potentially going to the New York Stock Exchange to ring the opening bell. Not confirmed, not public, but potentially.
That's huge. This is my stock market. It sort of signals a relationship with the stock market that many in the market are looking for. I am going to support this. If we start to see problems, maybe I will figure out a way of making that work well as well. The opening trade is wrapping up. The Pulse is coming up next. Big day ahead. Plenty of coverage as well. This is Bloomberg.